The truth about currency receipts. Why they matter for taxes, not exchange rates. If you've been holding onto stacks of Iraqi Dinar or Vietnamese Dong waiting for their value to rise, you've probably come across countless theories about what will happen when you finally exchange them. One of the most persistent myths circulating in the currency community is that your exchange rate will depend on whether you kept your purchase receipts. Some claim that people with receipts will get a preferred or higher rate, while those without will be stuck with a lesser one. This idea has caused confusion, anxiety, and even sleepless nights for some investors. But the truth is clear and simple. There will never be two different exchange rates for the same currency. In this article, we'll dig into why multiple exchange rates are legally and practically impossible, what your receipts are actually used for, and how they can make or break your tax situation once you exchange your currency. By the end, you'll understand exactly what matters and what doesn't when it comes to your dinar, dong, and those important pieces of paper called receipts. The myth of dual rates. Let's start with the most widespread rumor, the idea that there will be one rate for those who kept receipts and another rate for those who didn't. This misconception is rooted in confusion between currency exchange rules and tax rules. Banks and authorized currency exchangers cannot legally offer multiple exchange rates for the same currency at the same moment in time. It's not allowed under national or international banking regulations. When a currency has an official exchange rate, that rate applies equally to everyone, regardless of whether they have proof of purchase or not. Think about how you would exchange US dollars for euros at a bank. The teller doesn't ask, "Did you buy your dollars from Bank of America or Wells Fargo 5 years ago?" Nor do they give you a better rate because you can show a receipt from when you originally acquired the currency. The rate is the rate. Period. The same principle applies to any other currency, including the Iraqi Dinar or Vietnamese Dong. When a revaluation or rate adjustment happens, the official exchange rate will be set by the country's central bank and recognized worldwide. Every legitimate exchange location, whether it's a commercial bank, an airport currency counter, or a government-approved center, will honor that single rate. So, if you've been told that having receipts will somehow get you a special or higher rate, you can rest easy knowing that's a myth. What receipts are actually for? While receipts have nothing to do with your exchange rate, they're extremely important for a completely different reason. Your taxes. When you eventually exchange your dinar or dong for US dollars or any other currency, the IRS will view that transaction as a taxable event. That means you'll owe taxes on any profit you made, the difference between what you paid for the currency and what you received when you exchanged it. This is where receipts become critical. Receipts serve as your proof of purchase, showing when you bought your currency, how much you paid, and from whom you bought it. These details allow you to accurately calculate your cost basis, the amount you originally invested. Your cost basis determines how much of your total exchange value counts as taxable profit. Without receipts, you have no documented evidence of what you paid or when you bought the currency. And that can lead to some costly problems when it's time to file taxes. How receipts affect your tax calculation. Let's look at a practical example. Suppose you bought 1 million Iraqi dinar in 2018 for $800 and kept your receipt. A few years later, a revaluation occurs, and that 1 million dinar is now worth $50,000. Your profit, or capital gain, is the difference between the exchange amount and what you originally paid. $50,000, $800, $49,200, because you have receipts proving both your purchase amount and the date. The IRS recognizes that you've held this investment for more than a year. That qualifies you for the long-term capital gains tax rate, which is much lower than regular income tax. As of current IRS guidelines, long-term capital gains tax rates are 0%, 15%, or 20%, depending on your total income. Most middle-income investors fall in the 15% or 20% range. Now, imagine the same scenario without receipts. You go to file your taxes after the revaluation, but you can't prove when or how much you paid for your dinar. In that case, the IRS assumes you have no cost basis, meaning they treat your entire $50,000 as profit. They also assume you didn't hold the investment long enough for long-term treatment, so your gains are taxed as ordinary income. Ordinary income tax rates can go as high as 37% for federal taxes, and that's before adding any state taxes or potential penalties. The real difference receipts make. Let's compare two examples to see how dramatically receipts can affect your taxes. Sarah's case. Sarah purchased 2 million dinar in 2019 for $1,600. She saved her receipts and stored them securely. When the dinar revalues, her holdings become worth $80,000. Her profit is $78,400. Because she can show she held the investment for over a year, she qualifies for long-term capital gains tax at 20%, meaning she owes around $15,600 in federal taxes. Mike's case. Mike bought the same amount of dinar for the same price in 2019, but he didn't keep his receipts. When he exchanges his dinar for the same $80,000, he has no way to prove his purchase date or cost basis. The IRS treats the full $80,000 as profit and taxes it as ordinary income at 37%, leaving Mike with a tax bill of around $29,600. Mike pays about $14,000 more in taxes than Sarah, simply because he couldn't prove when or how much he paid for his currency. If he were audited, penalties and interest could push his tax burden above 40%. That's a huge and completely avoidable difference. What happens if you get audited? If the IRS selects your tax return for an audit, they'll want documentation to support your reported income and deductions. When it comes to currency exchanges, they'll ask for evidence showing 1. The date you bought the currency, 2. The amount you paid, 3. Proof that you actually own the currency before the exchange. If you can produce your receipts, the process is straightforward. The IRS verifies your information and confirms your reported profit. But if you tell the auditor you lost your receipts, things can get messy fast. The IRS has the authority to reclassify your transaction and calculate taxes in the least favorable way for you. They'll assume your entire exchange amount is profit and may apply ordinary income tax rates instead of capital gains rates. In addition, the IRS can impose penalties for underreporting income and charge interest on unpaid taxes. In extreme cases, if they believe you deliberately misrepresented information, they could pursue fraud charges, though that's rare and typically only happens if false documents were submitted. So, while missing receipts won't stop you from exchanging your currency, they could make your tax bill dramatically higher and leave you vulnerable if you're audited. What to do if you don't have receipts? If you've misplaced your original receipts, don't panic, but start gathering evidence now. Here are some ways to rebuild a paper trail. Contact your dealer. Most reputable currency dealers keep records of customer transactions and can issue duplicate receipts or purchase confirmations. Check bank or credit card statements. If you paid electronically, these statements show when and how much you spent. Search your email. Many online currency sellers send confirmation messages at the time of purchase. Print or save them as digital backups. Look for secondary documentation. Shipping labels, tracking numbers, or invoices can also help support your claim. Even if you can't find everything, partial documentation is better than none. Any credible proof can help establish your cost basis and holding period, both critical for tax purposes. What you shouldn't do, however, is try to recreate or fake receipts. The IRS takes falsified documentation very seriously. If you're caught submitting false records, you could face additional fines or even criminal penalties. It's always better to be honest and work with a tax professional to estimate a reasonable cost basis based on available evidence. What if the currency was a gift? If you received dinar, dong, or another foreign currency as a gift, the rules are slightly different. The general rule is that the recipient inherits the giver's original cost basis, meaning whatever the original owner paid becomes your basis for tax purposes. So if your uncle bought $1,000 worth of dinar and gifted it to you, your cost basis is also $1,000. However, you'll need documentation from your uncle showing his original purchase details. Without that, you'll be in the same situation as someone with no receipts, unable to prove your basis or holding period. Depending on the value of the gift taxes might also apply, especially for large amounts. Again, documentation protects everyone involved. What happens during the exchange when the time comes to actually exchange your currency? It's important to understand that the bank or exchange center does not care about your receipts. Their job is only to verify the authenticity of your notes, ensuring they're legitimate and not counterfeit. Once confirmed, they'll exchange your dinar or dong at the current official rate. They don't need or want to see your purchase records. Those stay with you for your tax files. The exchange process and the tax process are two completely separate steps. The first determines how much money you receive. The second determines how much of that money you get to keep after taxes. Why there can only be one exchange rate to understand why there can never be special rates for certain people. Let's look at how exchange rates work. Currency values are set by a combination of market demand, central bank policy, and international financial systems. When a revaluation happens, for example, if Iraq or Vietnam adjusts its official rate, that new rate becomes publicly available worldwide. Banks, currency exchanges, and financial institutions all use this same central rate, often with a small transaction spread to cover service fees. Offering two different rates to different customers for the same currency would violate banking regulations, anti-fraud laws, and foreign exchange compliance standards. In short, dual rates aren't just unlikely, they're illegal. The big takeaways. Let's recap the key points. 1. There will never be dual exchange rates. When the revaluation occurs, there will be one official rate for everyone, regardless of whether you kept receipts. 2. Receipts have nothing to do with the exchange rate. Banks don't care about them, only the IRS does. 3. Receipts determine your tax liability. They prove how much you paid and when, allowing you to qualify for long-term capital gains tax rates. 4. Without receipts, your entire exchange amount may be taxed as income. That could mean paying 37–40% in taxes instead of 20%. 5. Keep or recover documentation. Even partial proof helps. Duplicate receipts, bank statements, and emails all count. 6. Never falsify records. Honesty protects you, fake documents can destroy you. 7. Gifted currency still requires proof of the original owner's purchase. Keep a paper trail. 8. At the exchange, receipts aren't required. The bank just verifies authenticity. Your paperwork comes into play later, at tax time. Final thoughts. If you've been holding dinar or dong, your biggest worry shouldn't be getting a better rate at the exchange counter, because there's only one rate. Your real concern should be how to minimize your tax burden and avoid trouble with the IRS. Your receipts are your protection. They won't increase the value of your currency, but they will preserve your right to be taxed fairly. Losing them doesn't mean disaster, but it does mean you'll face more scrutiny, higher taxes, and possibly steep penalties if audited. So if you still have your receipts, treat them like gold. Keep them in a safe place, scan digital copies, and store backups online. If you've lost them, start gathering whatever evidence you can now. Don't wait until after the revaluation, when it's too late. Remember, the exchange rate will be the same for everyone, but your tax rate depends on the documentation you can provide. That's the real difference between a smart investor and a careless one. If this helped you understand how receipts actually work, share the knowledge. The more people know the truth, the fewer will fall for myths and misinformation. And when the time finally comes to exchange your currency, you'll be ready legally, financially, and confidently. Disclaimer: all content provided by IQD Global Intel is for educational and informational purposes only. We are not financial advisors and do not provide investment, trading, or banking advice. Viewers should always conduct their own research and consult with a licensed financial advisor before making any financial decisions.